I've seen investors earn 10% rates of return annually and still fall behind financially. And I've also seen people with very ordinary looking portfolios quietly become financially independent. And that observation, it's changed how I think about investing. My name's David Fagan, and I've spent over 2 decades as a chartered professional accountant, helping business owners, professionals, and families build stronger financial futures. And over that time, I've noticed something important. Some people earn decent investment returns and still struggle to build lasting wealth. I've come to believe that returns are not the same thing as outcomes. And over time, I think that distinction matters. Some people focus almost entirely on the portfolio performance. What did the account return? Was it 6%, 10%, 12%? But wealth performance is much larger than that. Maybe a better way to think about investing is the same way that we think about travel. When someone asks, "How was your flight?" most people comment on how the plane performed in the air. But did you get to the airport in plenty of time? Did you breeze through security? Were there any delays along the way? And here's the big one, did all of your luggage arrive with you on the back end? Maybe we can think about investing this same way. The total returns inside your portfolio, they matter, but it's only one part of the overall outcome. Your total return is affected by behavior, emotional decisions, idle cash, the structure that you put around your investing framework, taxes, and whether compounding gets interrupted along the way. That's what I call total wealth performance, a more complete way to think about wealth creation over a very long period of time. On the behavioral side of investing, one thing that I've noticed is that some of the biggest financial decisions that people make, they happen during some of the most emotional periods of their lives. Think about this. A business gets sold. You inherit money. A property may transition, or heaven forbid a divorce happens. And suddenly there's a significant amount of capital just sitting there without a clear plan. Not because people are irresponsible. No, it's because life gets complicated, and uncertainty often creates delays in investing. And I've seen people leave large amounts of money just sitting in cash for years while trying to decide what to do, how to invest it, when to invest it. And that delay, that costs real dollars. I was reviewing a client's investment statement last year, and while the portfolio earned around 18%, which was approximately the market return for that year, most people would look at that and think, that was a great year. He compounded at market rates. But when I stepped back and looked at the client's total financial picture, there was a large amount of cash, investable cash, sitting outside the portfolio for most of the year. The client absolutely wanted to invest that money, but like so many people was trying to wait for a better entry point into the market. And honestly, that's incredibly common. I mean, I've certainly made that mistake myself as well. So while the portfolio itself earned roughly 18%, their actual total wealth performance was closer to 15%. Same markets, same investments, but a different reported outcome. Because the money outside the portfolio, that matters too. This is one of the reasons that I found the Charles Schwab study, Does Market Timing Work, so fascinating. In this study, Peter Perfect was able to perfectly time every market bottom each year over a 20-year period. Perfect entry points. But what fascinated me wasn't Peter Perfect, because of course no one can be that person. It was Larry Linger. Larry kept waiting for a better opportunity to invest. He assumed that lower prices were always just around the corner. And over time, the cost of waiting became enormous. I think there's a really important lesson in that. Wealth creation is often less about perfection and more about participation. One thing that I've learned over the years as well is there are many ways to build wealth. I've seen people create financial independence through real estate, private companies, concentrated stock portfolios, long-term disciplined investing, and combinations of all of those scenarios together. There isn't just one path. Compounding simplicity, where we simply buy the entire market, is one of the philosophies that has resonated most with me, because I've seen how powerful, easy, and repeatable systems can become over long periods of time. In my experience, wealth creation is often less about finding the best strategy and more about finding the strategy that you can consistently stick with. Simple systems are easier to follow. Easier systems often create better behavior, and better behavior usually leads to better long-term outcomes. That's especially true during difficult periods of time, because compounding doesn't just require returns, it requires survival, it requires discipline, it requires staying invested long enough for the math to actually matter. And then finally, on the back end of total wealth performance, there's taxes, which I believe are still one of the most overlooked parts of investing, especially here in Canada. Two investors can earn the exact same gross rate of returns and end up in dramatically different outcomes after tax. If one investor constantly creates taxable events through turnover and distributions, and the other allows capital to compound quietly for decades, that difference, it becomes enormous over time, especially inside corporations, especially over 20 or 30 years. This is really the larger idea behind total wealth performance. A portfolio might show a 10% rate of return on paper, but if money sat idle before investing, behavior interrupted the process, and taxes created drag along the way, the actual long-term outcome may begin to look closer to 6%. And over decades, that gap between 10 and 6%, that's massive. Compounding is incredibly sensitive to interruption, and the people who often win financially are usually the people who stay disciplined, avoid major mistakes, keep taxes low, and allow compounding to continue uninterrupted. Because once compounding starts working in your favor, you want to ride that wave forever.